The worst is yet to come. Out of a Washington Post story I saw today, Challenger Gray and Christmas, a firm that tracks workforce reductions, estimates that U.S. employers announced more than 800,000 job cuts year to date. That's the highest since, or the highest between January and August, going back to 2020 when everything was shutting down because of the pandemic. Federal workforce reductions, economic and market conditions, store and plant closings, and restructuring and bankruptcies ranked among the most commonly cited motivations for layoffs, and more than 10,000 cuts were explicitly tied to artificial intelligence. Do you think for a second that that number is going to get less? Or do you think, like I do, that number is going to keep growing exponentially as companies embrace AI because they can start becoming more efficient and therefore more profitable for their shareholders? It's just the beginning with AI. Retail job losses skyrocketed, up 242% through August compared with the same period last year, according to Challenger, affecting roughly 83,500 positions. Meanwhile, nearly 6,000 stores shuttered in the first half of 2025, according to data from CoreSite Research. Mark Cohen, former director of retail studies at Columbia Business School, expects those numbers to grow. Retail and support is well over 70% of the economy's makeup right now. Yet we have massive layoffs in those sectors. The reason why I want to share this story with you, I had a comment on Friday's video, actually from my dad. And I read the comment first before I realized it was from him. And he said the jobs numbers will be much better by the winter time. And I think I responded to him last night and said, I sure hope so. Something to that effect. Then I realized it was my dad. But I see this article today and I'm convinced more so than ever that this is going to get a lot uglier. Okay. And, who's to say what data is out there to show or support that we're going to see jobs coming back. Okay. Let me share the story with you before I start. Please subscribe to the channel, guys, if you're not subscribed. I do appreciate it very much. It's a free and easy way to support the channel, and we are growing the community. So on the heels of that comment from my dad, I wanted to share this story. I'll dig in a little bit deeper, but this is, look, everybody is banking on rate cuts in September, okay? And the markets are betting there's going to be several rate cuts coming. From my perspective, relative to the housing market, are you really going to see a real reduction in the inventory of houses on this sitting on the markets in the United States because you get, a couple 50 basis point rate cuts, right? Who's going to move out of there or let's say abandon their 3% mortgage for something even in the 4.5%, 5.5%? It's not going to happen. Love to get your thoughts and input. Rate cuts are not going to solve the housing collapse in this country. Let's talk about the stock market briefly. I don't know if you saw Travis Economic Ninja show this morning, but he brought up something that I had not heard this before, but it laid out the scenario that unfolded in September 2007, okay, just before the great financial crisis. And what he shared is that there was a jobs report that came out in September. It showed job losses and revisions on prior months, just like we got Friday, okay? The Fed cut 50 basis points in September of 2007. And initially the stock market, the S&P rallied on that, right? Free money, keep the party going. But then the October non-farm payrolls report came out and it showed it was bad numbers. Okay, and what happened? A little bit of a bump in the S&P, and then after that, in regard to every rate cut that took place thereafter, the S&P fell dramatically. Okay, so are we following the same pattern as we saw in 2007? We'll have to wait and see how it plays out. Okay, but don't forget, rate cuts don't help the common man or woman on the street that are barely making ends meet. Okay, their credit's already shot. They're already maxed out on all their lines, their HELOCs. They've borrowed from their home, and they're tapped out. And meanwhile, they're having they're suffering through substantial job losses, unemployment, people in the family that can't find a job as hard as they try. That's going to keep getting worse regardless of rate cuts. Okay, so why would rate cuts bring back the jobs market? Why would rate cuts bring back the housing market and clear all the mass inventory sitting there right now? And why would rate cuts lead to an ongoing, high after high in the S&P and the stock market? If history tells us anything, it's not going to. So this is the toughest, back to this Washington Post article, this is the toughest time in years, it says, to be searching for work in America. Data last week showed a fourth month of tepid job growth and propelled joblessness to its highest level, or that propelled joblessness to its highest level since late 2021. It says many are shedding payrolls, many companies are shedding payrolls and shifting tasks to artificial intelligence while pulling in higher profits. Okay, and we understand the goal of corporations is to maximize return for their shareholders. They don't care if it's at the expense of employees. Okay, hardly any corner of the economy is untouched right now, it says, by job cuts and slowdown. Employment in all goods producing industries slumped in August, with the deepest losses coming from manufacturing and mining. The service sector was racked by steep layoffs in business and professional services and IT. Job vacancies are shrinking as employers hold fire on hiring, meaning they're slowing down on their hiring. Factor in dimming consumer sentiment. Once you factor in consumer sentiment, which is getting worse, which just recently hit a 3-month low in August, says the conditions are ripe for labor market gridlock, according to Bill Adams, chief economist for Comerica Bank in Dallas. As we know from Friday's data, non-farm payroll, we only added 22,000 jobs in August, well below expectations. Unemployment rate pushed up to 4.3%. We know there were revisions for the prior 2 months, leading to actual negative jobs lost. Pace of layoffs has picked up somewhat. The hiring rate remains quite low, said Mike Frantoni, chief economist and senior vice president of research at Mortgage Bankers Association. It's increasingly difficult for those laid off and for new entrants into the job market to find a position. The tech sector, listen to this. Let me share some stats. Tech sector shed 150,000 workers in 2024 and has had several large-scale layoffs. This year, Microsoft has cut 15,000 despite soaring sales. Again, they don't care. The layoffs, actually, if you look at some of these companies, when they lay off, the following days and weeks, their stock price goes up. Many brands are working to free up capital for AI and related investments. As such, executives including NVIDIA's Jensen Huang and Anthropic's Dario Amodei are warning of the potential for AI to spark sweeping job losses down the line. Intel's cut thousands of workers, mostly in Oregon and California, and plans to cut more. Salesforce in August, CEO Mark Benioff said that AI is easing workloads enough to allow him to slash 4,000 off the company's ranks. He says, because I need less heads. They look at their employees as heads. They need less heads because they have AI doing some of the heavy lifting, and stock prices go up. That's not going to improve. Oracle, stock up more than 40% this year amid booming AI demand. Warn notices, which employers are required to file 60 days before a mass layoff or plant closing, show the company plans to cut thousands of jobs across Washington, Texas, and Kansas in the coming months. Cisco stock price up 15% for the year, said it would cut hundreds of roles, including many software engineers, even as the company reported a spike in sales last quarter, boosting its revenue beyond $14.5 billion. In energy, rising costs and lower oil prices are causing firms to pull back. Halliburton joining the ranks of companies trimming headcount in recent weeks. ConocoPhillips, the oil company, announced plans this week to cut 20 to 25% of its global workforce. So, guys, get your thoughts and comments. Are we going to see a repeat of what happened in 2007 as the jobs numbers keep coming in weak? The Fed keeps cutting because they're behind the curve, and the stock market sell off, housing market collapses. We know what happened into 2008 and 2009. Okay, so with that being said, it just is reality. And so for all, the cheerleaders saying, well, these rate cuts are going to be the panacea, everything's going to automatically just be fixed, jobs will come back, housing inventory will get cleared, and the stock market will keep reaching all-time highs. I, for one, do not think that's the case. The whole paradigm has shifted, okay? The corporate paradigm, because AI is now in the fold big time and not going away. And you have consumers that are in horrible, horrible shape. Many of them can't go out and buy a house even if they want. Let's say rates were 3% again. How many people have good enough credit, good enough jobs, have their debts in order, their debt to income ratios appropriate? They can actually go out now and buy a home when they've been, dipping into credit card lines just to put food on the table. So with that being said, I don't want to go too long. Again, thank you for watching the shows. If you enjoy the content, leave me a like, subscribe to the channel, leave your thoughts and comments. And with that being said, I'll talk to all of you soon. Bye.